SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi high-level policy panel on navigating monetary tightening through fragile markets. Well-functioning financial markets are vital for an effective conduct of monetary policy. 2022 has seen an unprecedented global tightening of monetary policy. In parallel, stress emerged in many segments of financial markets, ranging from highly risky instruments, for instance crypto, to supposedly safe assets, like UK gilts. Against the backdrop of global market swings, a unique set of concerns for central banks in Europe and North America has emerged. Among them are how to deal with fragility in the market environment, how to bring inflation back to target while preserving financial stability, and, for instance, should central banks assume a role of market maker of last resort? A distinguished panel of senior policymakers and academics will discuss these and further topics following an introductory overview of the main issues. We are honored that Cornelia Holthausen, the Director-General of Macroprudential Policy and Financial Stability at the European Central Bank, will moderate today's event. Our special thanks goes to Martin Scheicher, advisor at the Directorate-General Horizontal Line Supervision of the Single Supervisory Mechanism, who initiated this event and is the brain behind it. Without further ado, over to you, Cornelia.
Thank you very much, Ernest, and welcome everyone to this very interesting, I hope, panel on navigating monetary tightening through fragile markets. And I can only echo Ernest and that we are in very interesting and challenging times for central banks, with interest rates rising at the fastest pace on record, I think, and being a worldwide phenomenon to cope with the jump in inflation. And at the same time, central banks sitting on huge portfolios of bonds and other assets that they are starting to unwind, and that at a time when actually many governments are taking on new debt. And also all of these recent developments put strains on households, firms, intermediaries, and markets. And we will see and how far some of them are quite exposed to this situation. So how is the financial system able to cope? How can central banks best navigate monetary tightening in this environment? These are exciting questions, and I'm very happy to now introduce our very distinguished panel for today. So let me start with you, Darrell. Darrell Duffie is a highly acknowledged financial economist. He's currently the Adams Distinguished Professor of Management and Professor of Finance at the Graduate School of Business at Stanford. He has more than 100 research publications on a really wide range of topics in finance, and has written many of groundbreaking papers and books in asset pricing and trading. And many of his papers have provided cornerstones for key areas of financial economics. Then Dan Tarullo is currently Nomura Professor of International Financial Regulatory Practice at Harvard Law School. And he has been at the forefront of economic policy making in the US public sector, serving, for instance, in the Department of Justice, National Economic Council, and the National Security Council. And he has also served on the Federal Reserve Board for a number of years. As oversight governor for supervision and regulation, he led the board's financial regulatory reforms, including the implementation of the Dodd-Frank Act. And Peter Praet, who I, of course, know still quite well from your time at the ECB. You spent most of your long and distinguished career in central banking. You retired in 2019 as chief economist of the ECB, where you were responsible for monetary policy. And before working here, you served as executive director of the Belgian central banks for many years. So you have a unique perspective on euro area monetary policy since the start of the euro. So it's really a great pleasure to have these three senior and very knowledgeable experts here today. So welcome. Before I open the panel, though, I would like to give the floor to my esteemed colleague Martin Scheicher, who will start off with an overview presentation of recent developments. Martin is advisor in our Director-General Horizontal Line Supervision and the SSM, and he has done a lot of work on derivatives, OTC markets, and financial market infrastructure. So the floor is yours, Martin.
Thank you, Cornelia. Let me start with my introductory presentation. And to sort of set the scene, here is a quote from the Clinton administration. So 30 years ago, James Carville, almost to the day, said, "I used to think if there was reincarnation, I wanted to come back as the president or the Pope or a 400 baseball hitter. But now I want to come back as the bond market. You can intimidate everybody." So this basically shows that this topic of the role of the bond market, and it's actually also political power, has been on the agenda for quite some time. And with this quote, I would like to start the presentation, as Ernest already said. So we are currently in a somewhat turbulent area, turbulent end of the low rate era. And for the panel and our discussion today, I would suggest three themes, basically. So first of all, since the global financial crisis, the loose monetary policy and has led to low rates and high volumes of quantitative easing, so basically purchasing of all kinds of assets by central banks. This has also led to a global trend of rising valuation. So in particular, the hunt for yield has increased the prices of many types of assets. And so we see, as some commentators have put this, a bubble in almost everything. In addition to the very strong rise of valuations in the public markets, we also see a strong growth of private asset markets and non-banks. So for instance, trading firms. And we will talk about this later on, because this is also one of the core themes of the current financial system. Speaking of the structure of the financial system, plumbing of markets has also changed. We see much more electronic trading, which has replaced the setup around bank-centric markets. And linked to this electronic trading, we also see an highly increased use of central clearing, which has led to mechanical margining of volatility and repeated episodes of dash for cash, where in particular non-banks quickly need to cover the margin call. So all of this, as already highlighted, has led to unique policy changes, basically tightening monetary policy to fight inflation, while at the same time preserving financial stability. And the key theme really here is supporting the resilience of, in particular, the bond market. Let me start here with a quick overview of the long-run developments. This is really the era since the quote of James Carville 30 years ago. We see this long-term trend downward in the US Treasury yield. At the same time, the S&P 500 grew by basically around 500%. Volatility broadly stable, but also at the same time a sharp rise in volume, so much more trading activity. Coming back to this theme of current valuations, which are of course challenged by rising rates. Here the starting point is prudent portfolio management would require, perhaps not everybody did this in the last decade, to discount future cash flows with what are realistic risk premia and not sky-high valuations, and actually from time to time also consider the risk-return trade-off. In contrast, the last decade brought us many cases of something like irrational exuberance. Here are a few examples. We've had what many commentators see as another bubble in the technology sector. Here really the WeWork episode is a particularly shining example of outrageous valuations, and appropriately enough has been turned into a TV series called We Crashed. Then we have this whole topic of crypto valuations. One of our board members has described this as the bubble of a generation. The high valuations of private assets, in particular, the very high premium of venture capital or private equity investments relative to the public stock market, which raises the question of whether these valuations are actually sustainable. And last, but certainly not least, also strong growth in house prices, and certainly a bubble. We can define a bubble in certain countries, and as the governor of what is the world's oldest central bank put it, sitting on a volcano. So basically all of this together means that there are many sources of fragility in the financial system, and what we see in the current situation is initial tightening of pricing last year, but now again, actually quite strong optimism of market participants about the monetary policy path. So this will also be one of the topics of our panel. And I understand that Peter will comment on this, which actually recently again has led to a loosening of financial conditions in major economies. So let's briefly look at major structural changes in the last decade. So in particular, the plumbing has changed in many parts. So first of all, there is a strong growth of non-banks who replaced banks in many crucial sectors of financial intermediation. One sector where non-banks now really play quite a large role is trading. This has also led to a to strong changes in the process of liquidity provision, and given the pronounced progress of trading firms, the so-called principal trading firms, these have replaced the bilateral intermediation. Key markets where this has already happened are US and US corporate and treasury bonds on the European side, also bond futures, which actually, in particular in the case of the euro area, play a major role in terms of price discoveries. Central counterparties have created the process of mechanical margining of volatility. Here we've also seen a couple of episodes, two mentioned on the slide, the GameStop equity volatility and UK gilt stress last year. But of course, last year we've also seen the same mechanisms played out in energy markets. So the general impact is faster trading, which has led to more funding liquidity risk. People need to pay the margin calls, but actually also market liquidity risk, people trying to sell safe assets, and in some cases, due to dislocations, like in the UK gilt case study last year, not really being able to do so. So let's quickly look at the evidence for the non-bank financial sector. This is an illustration for the euro area from ECB data, which shows that this the share of non-financial corporations has gone up from 15 to 26%, and total assets now exceed actually the sum of the total assets on the balance sheets of banks under our supervision. These firms now have a systemic role, so this in particular raises the policy question of how resilient are they? Is there hidden leverage and liquidity risk? Another topic, one of the main themes today, and one on which Darrell has worked extensively, is the bond market. So I start here with a quote from a paper in 2018, which really summarizes the issue in a very concise manner. Balance sheet space on the side of the dealers is now treated like expensive real estate, available only to positions that can afford to pay rental fees that are now much larger. So bank dealers have reduced their presence in this market. They've moved from market making to matchmaking. We see active electronic trading. We have seen in the US also and also in the euro area a number of flash crashes. So very brief episodes of very high volatility, which are partly related to electronic trading and the role of inventories. Non-bank dealers growing sharply, and bank dealers still dominating the dealer client trading. And here there is an illustration for the euro area bank bond holdings. All of this together has led to many policy challenges for central banks. The market environment which we are facing is quite challenging. On the monetary policy side, we have on the one hand strong investor optimism, but on the other hand still continuing concerns about reaching price stability, wage pressures in certain sectors, and also the differences in inflation between services and goods. So overall, the financial system has, to put something positive here also into the discussion, has, without major losses, but of course also with quite significant central bank action, has recently weathered two large shocks, so two really exogenous events. This was on the one hand the corona shock, and then also the inflation and energy shock. So in this post-global financial crisis setup, so far we have not seen globally systemic events, but really quite actually repeated cases of smaller but still quite pronounced stress events, sometimes also called this tantrum. So all of this basically means that financial stability policy faces particular challenges, in particular when it comes to liquidity risks at non-banks, and also other issues to fine-tuning the current supervisory and regulatory setup. And Dan is going to talk about this in more detail. And in parallel, not to forget this, of course, to the work on financial stability and monetary policy, there is also the issue of dealing with climate risk as a vital new concern for policymakers, which also actually raises the question in an international discussion of what central banks can do about this. So coming back to the bond market, central banks basically have increased the policy rates and also have cut down or have reversed bond purchases. And just to give an illustration, as of last year, 27 trillion of bonds were held by major central banks, and before the global financial crisis, this was 4 trillion. So this implies that the Fed is owning almost a third of all US treasuries, and the Euro system around 40% of Euro area public debt. So the situation of the large holdings of central banks plus rising indebtedness on the side of the public sector plus weakened dealer banks creates, of course, quite a lot of headwinds for the bond market, and really puts the imbalance between demand and supply under particular emphasis. So this, of course, also means that actually the dealers in whatever form, banks or non-banks, face rising pressures to step in. And we have seen this already in a couple of episodes. And here, one particular case study outside our usual focus is what is happening here in Japan. We have seen the start of a bit of inflation, but also managing a bond yield cap with at the same time very high debt burden creates particular challenges for a central bank. So to illustrate this, here are time series of indicators of market liquidity, price-based measures, and I would like to draw your attention here to the UK, where we really see the impact of the mini budget, so quite a sizable impact really in September, and also the trend of a deterioration in market liquidity in Japan, which has been going on for quite some time. So this really highlights the fragility of many market segments. And with this, I would already come to the last slide in my presentation. We've talked about monetary policy, and in particular, Peter is going to comment on this. But of course, also there are many work streams on an international level currently dealing with financial stability. And to give a bit of background to the panel discussion here, I'm giving a quick overview of major work streams, in particular to increase non-bank resilience, but also to strengthen the decentralized intermediation in bonds. And this, of course, is in particular relevant to, as Darrell calls it, the world safe assets, or US treasuries. So we have a couple of different initiatives. One is on the side of CCPs to reduce the procyclicality in margin calls. Bank dealers, there is a discussion, sometimes actually quite controversial, on whether we should adjust the leverage ratio to reduce balance sheet costs. Market structure, can we move to a more resilient market structure where the dealers are not really facing the problem of bottleneck, and so many other connections would then be possible in this all-to-all. Transparency, of course, is also a topic on the European side, with discussions about a comprehensive tape, really, which would allow market participants to have a better overview of what's happening in the bond market. On the side of central banks, there is also the policy and political question of how to define the market maker of last resort. And then finally, on non-bank financial intermediations, there's the issue of leverage, and also basically since the global financial crisis, the recurring issue of the vulnerabilities in money market funds. And with this, I would close my overview presentation and hand back to Cornelia.
Thank you very much, Martin, for setting the scene. So as we see, it's a quite challenging and unique environment that we are in currently. So let me now give the floor to our panelists. So Darrell, As just shown by Martin, we are facing significant risks in the fixed income market. And as you have been closely involved in the US policy reform process, I would be interested to hear your views about this very unique episode in financial stability history and its main lessons. And in particular, what could be, in your view, the role of central banks? The floor is yours.
Cornelia, thank you so much. It's a terrific pleasure to speak with you and this wonderful panel. And I'm actually going to pick up the baton immediately from Martin's remarks. I want to turn back the clock to September 22nd of last year. The Monetary Policy Committee of the Bank of England announced on that day that it would begin quantitative tightening by selling gilts. The very next day, Prime Minister Truss's budget announcement caused havoc, and leveraged driven investors fire sold their gilts. On September the 28th, the Financial Policy Committee, a different committee of the Bank of England, announced that it would be purchasing gilts in an attempt to restore market function. Shortly after, Bank of England Governor Andrew Bailey at the IMF made this widely quoted comment, quote, "There may appear to be a tension here between tightening monetary policy as we must, including so-called quantitative tightening, and buying government debt to ease a critical threat to financial stability." So I think he's captured the spirit of this session in a nutshell. On the one hand, monetary policy is the main domain and responsibility of central banks, but on the other hand, financial markets have not been cooperating with that. If you could, Dragana, turn to the next slide. I'm going to go back to a different episode in March of 2020 when COVID was declared a global pandemic. You can see from this histogram of foreign gross sales of US Treasuries that the quantity of treasuries sold by foreign investors to US dealers jumped from the typical median level of around $1.25 trillion a month to 2.7 trillion that month, more than double the norm. And US dealers were overwhelmed, not just by these foreign sales, but by domestic sales of treasuries. They were not equipped to handle those sales. Next slide, please, Dragana. This is the structure schematically of the US Treasury market. The green dots are the large dealers. There is a piece of market furniture in the middle of them called a central limit order book. It's operated by BrokerTec. And that is an all-to-all centrally cleared market, but for the dealers. The blue dots are the customers of the dealers. That's every investor in the world other than dealers. When they need to buy or sell treasuries, and this is true in most jurisdictions, they must sell to a dealer or buy from a dealer. And that means dealer balance sheet space is crucial, as Martin mentioned. When March 2020 pandemic hit, the blue dots sold treasuries like crazy, and the green dot balance sheets were overwhelmed. This market structure is not sufficient, at least not with current regulation. I would also say that there is a problem with safety and soundness of settlement in that interdealer market, where mixed among the dealers are special purpose high frequency trading firms, sometimes called PTFs, whose trades in that market at the central limit order book are not centrally cleared. In fact, the platform operator BrokerTec is responsible for settling their trades, and it's not regulated or capitalized as such. It's not a central counterparty. So this market structure is not safe and sound, and recently the Securities and Exchange Commission has unanimously proposed that the Treasury market be centrally cleared. This is one of Martin's key points. Central clearing would also increase the likelihood that the blue dots would be able to join into all-to-all trade and not be excluded from the efficiencies of all-to-all trade. With that, they would not necessarily need to impose on dealer balance sheet space, since they could trade directly with each other rather than through dealers. Next slide, please, Dragana. When March 2020 volumes soared and the dealers couldn't handle it, they rationed balance sheet space by increasing their bid-offer spreads by a factor of about 15 to 20, especially in the off-the-run market. Next slide, please. In the interdealer market, the quantity offered at the best available quotes plummeted from a typical depth of about 175 million for the on-the-run 10 years to virtually nothing. The market was declared dysfunctional even by the Fed. Next slide, please. And the reason for that, the proximate cause, is that the Treasury market had grown too big relative to primary dealer balance sheets. This slide shows the ratio of Treasuries outstanding to the total balance sheets of all global primary dealers in US Treasury securities. Pre-crisis, the amount of Treasuries per unit of balance sheet space was declining as primary dealers had no problem absorbing those flows. In fact, they were under-regulated, undercapitalized, and not subject to sufficient liquidity requirements. When the crisis hit, regulators got religion and required that those dealers meet strong capital and liquidity requirements. That was good, but that meant that their balance sheet space was not going to grow with the Treasury market, and the quantity of Treasury securities increased dramatically by a factor of 3 relative to dealer balance sheet space. And when March 2020 hit, there was just not enough balance sheet space to absorb those flows. Next slide, please. What did the Fed do? It stepped in with massive purchases. In the first 3 weeks alone after the mid-March pandemic crisis was declared, the Fed bought almost $1 trillion of Treasuries, digging out those dealer balance sheets so that there would be more space for dealers to intermediate customer flows. However, the Fed kept on buying, and it was not clear, at least to me and many others, when these market function purchases became, in effect, quantitative easing. In this case, it wasn't really a big problem because both market functioning and monetary accommodation suggested purchases of Treasuries. But let's go back to the gilt example of last year when the Bank of England was ostensibly tightening for monetary policy purposes, but ended up having to purchase gilts in order to cure a market dysfunction. So this represents, on top of all of the financial stability concerns, a problem for central banks in managing their monetary policy. When monetary policy is not congruent with market function purchases, we have a problem. Next slide, please. So first, when should central banks step in? Well, here I'm not going to review these in the interest of time. This is from new work being done here by myself and others at the New York Fed. But basically, we have a panel of illiquidity measures in the US Treasury market, including price impact, bid-offer spread, price dispersion, market depth, on-the-run premium, and yield curve noise. And all of these soared in March 2020. So it was very clear at that time. More recently, however, these vulnerability measures are still climbing, and central banks need to, I think, provide transparency over the circumstances under which they would step in. In new work that will appear shortly, Frank Keene here at the New York Fed and I are proposing a transparent market function purchase program for central banks to deploy so that all investors will know that their government securities have a liquidity backstop and that will be priced into those securities when they're originally issued by the government. The title of the slide says, how much illiquidity should trigger official sector purchases? Why would I use a term like official sector when I just mentioned the central bank? Frank and I also raise the possibility that fiscal authorities, not just central banks, could take responsibility for these purchases, alleviating central banks of this tension between monetary policy and market function purchases whenever that tension arises. This raises a host of interesting questions regarding central bank independence, the funding of fiscal authority purchases, legal authorities, and other issues. Next slide, please. This is my last slide. I just want to quickly review. It sounds as though Martin and I have been spending days together agreeing on what should be done, but in fact, we are agreeing. Broad central clearing mandates, that's number one. Financing facilities for government securities that are special purpose for these situations so that investors who don't necessarily want to sell can get financing from the central bank. So this is lending of last resort, not market making of last resort. Number three, as I just mentioned, make it transparent that official sector market function purchase programs exist. This will mitigate the onset of these periods of market instability in government securities markets, especially if they're triggered by insufficient capacity of dealers. And it will get priced into those securities when they're issued, lowering the cost to governments for issuing their securities. Number four, revise bank capital regulations, which were partly responsible for limiting the available balance sheet space. Number five, and as Martin also said, publicly report government securities trades. Martin mentioned there's no consolidated tape in Europe. In the United States, there's no tape at all. The transactions are simply not reported, and they should be. That would help. And then finally, number six, in the United States, treasuries are exempted from fair access regulations of trade platforms. And you might say, come again? You mean the trade platforms are allowed to not provide fair access to those that wish to trade treasury securities? For some reason, the US government has exempted their own securities from these regulations. I think it's time to revisit that, and so does the SEC. That's it for me. Thank you, Cornelia.
Thank you very much, Darrell. Very interesting, and I'd love to hear more about your work on what could be potential triggers or thresholds for central bank intervention in volatile markets, but we can get back to that later. So for now, let me now give the floor to Dan. Well, Dan, you have been analyzing bank capital already in your book, Banking on Basel, in 2008, and you also led the US efforts at reforming the regulatory reform in the aftermath of 2008. So question to you, do you think banks nowadays hold enough capital given the current risks? And what could regulators and supervisors do in the current environment to increase systemic resilience?
Thank you, Cornelia, and thank you also for the invitation to discuss things today. Martin has, I think, set up the conditions that any central banker who also has financial stability responsibilities faces right now. And I just want to mention at the outset a couple of points. One, if I think back to the kind of briefings we used to get from our financial stability people at the Fed, right now, there aren't really a lot of indicators that are flashing red. There are some that we would think of as bright yellow. Leverage lending, which has been increasing at about a 14% annual rate for the last 25 years, is almost surely vulnerable because much of the funding for leverage lending is rollover funding, and that means the interest rates adjust. And I don't think that's all been absorbed yet from the recent Fed price increases. In general, the picture on liquidity is not too reassuring. Darrell has already discussed the Treasury market, but a lot of other key financial markets seem short on liquidity, especially when you consider how much the Fed has been pumping in over the last couple of years, and that's a kind of chronic concern as well. I would also say that if the path of interest rates or the duration of rates at higher levels is longer than, at least up until the last couple of weeks, markets have been expecting, we're probably going to see some areas that are pretty opaque right now begin to reveal stress. I mean, I think that's what we saw in the UK pension market, for example, something that probably didn't come across the screen of the FPC at the Bank of England. There are going to be things like that in the United States as well that the Fed just doesn't have a window into. So I guess I'm presenting a case in which there's cause for concern, but at least as of the moment, we don't see anything grossly worrisome. But even if we did, I just want to mention that once problems begin to erupt, you really can't do much on the regulatory side to counteract them. If there's a shortage of liquidity and you think, well, it would have been better if there hadn't been so much borrowing, the answer in a stress period is not to say, let's restrict borrowing further in order to get it down. So essentially, I'm going to abstract from current conditions a bit to ask to address the questions Cornelia identified, which is how is the banking sector doing generally? What did we learn from COVID and the COVID episode, and now from the fast rising rates? And more ominously, I think, what about the non-banking sector, which Martin highlighted in his introduction? So first, because of the post-global financial crisis reforms at the Basel Committee and the Financial Stability Board, I think banks were decidedly a source of strength rather than vulnerability during the worst of the COVID period in 2020. But I don't, as some of the banks take a lot of comfort from that. I take rather less comfort from that experience. The shock didn't grow out of the banking system itself. It was a genuinely exogenous shock. And so it was not like the 2007-2008 episode where things began crumbling from within. And of course, the massive amounts of fiscal and monetary stimulus just buffered any losses that banks might otherwise have absorbed. So I was reassured, felt vindicated, along with probably Peter and many other people who have worked on financial regulation over the years. But I don't think that we're at the point where we can say mission accomplished for banks. So what about capital levels, which Cornelia mentioned specifically for banks? Well, a number of years ago, 4 or 5 years ago, there was just a spate of studies from some central banks, from academics, which kind of converged around 14% Tier 1 common equity as the best balance of financial stability and productive intermediation for large banks. Now, there are obviously a lot of assumptions and judgments that go into any study like that, but I was struck by the fact that even with some different methodologies, studies, at least non-bank funded studies, sort of were coming to similar conclusions. As a point of comparison, the US GSIBs, the 8 US GSIBs today, mostly fall in the 10 to 12% range. So one can at least ask the question as to whether somewhat higher capital would be desirable. Now, to me, the better way to approach this issue, both the evaluation or assessment of whether we have a bit of a capital shortfall and the method of filling that shortfall, if one is determined, would be through stress testing. And I say that because when you use stress testing, you're actually trying to focus on the individual circumstances of banks in effort to determine the vulnerabilities which they face, and you're not trying simply, for example, to increase GSIB surcharges, which are necessarily based on aggregated information and not so tuned to the risks of specific banks. And then, of course, when you complete the stress test, you can impose, in the United States now, the stress capital buffer, which complement or accommodates the kinds of risk that the particular bank is facing. So for me, the better route would be to reinvigorate stress testing, to make it more of the dynamic supervisory tool, which I think it was intended to be when it was put in place in the US and the EU and the UK and other areas, but which frankly has lost a good bit of its dynamism in the United States over the last several years. It's something, it's become a little bit more akin to a compliance exercise with a the model is essentially known by the banks. The scenario is a single scenario, does not change all that much from year to year. Some of the parameters will be moved a bit, but it doesn't really change in any fundamental way. And of course, that rests upon the false premise that we know what the next stress event will look like. So for me, the better route would be to reintroduce multiple scenarios, to truly try to evaluate the bank conditions a situation under different kinds of stress conditions, and then to, as appropriate, recalibrate the stress capital buffer, bank capital requirements as a result of the stress test. And that would cover both the G-SIBs and, in the United States, the very large regional banks as well. So what's the downside of trying to do that? Well, there are some technical challenges, to be sure. There are also some challenges in getting the stress test to be less pro-cyclical. But one of the things that concerns me now is that the discretion necessary to make for a dynamic stress test over time, to change scenarios, to alter the model, to take account of market developments and changes in risk correlations, all that discretion can be used in the other direction, which is to drain the stress test of dynamism to make it more of a compliance exercise. And that happens in an essentially non-transparent fashion. It's just what the Fed does, what the scenarios look like, what the behind-the-scenes rules are. And to be honest, I think that's what we saw in the 2018 to 2022 period. So I think current regulators have to at least think about a blunter approach of a higher G-SIB surcharge, for example, if they conclude that there doesn't need to be an increase in capital. But that, to me, is decidedly second best. A quite different change in regulatory capital requirements in pursuit of financial stability is one that both Martin and Darrell have already mentioned. And that's the impact of what we call in the U.S. the enhanced supplementary leverage ratio on the largest banks. In the United States, the so-called supplementary leverage ratio is the Basel leverage ratio, which is to say it takes into account off-balance sheet assets as well as balance sheet assets. There's a variety of complex conversion factors to get balance sheet equivalence. That's a minimum 3%, applicable to all internationally active banks. A decade ago, the United States put in place a 2% surcharge on the supplementary leverage ratio, bringing it up to 5% for all 8 of the global systemically important banks, regardless of what their risk-weighted surcharge was. So, for example, a couple of banks like Wells Fargo had higher leverage ratio surcharges than they did risk-weighted surcharges, which seems highly counterintuitive. Now, at the time, the analysis that was done at the Fed, the New York Fed, and elsewhere indicated there could be some issues with this along the way, but with the expected trajectory of central bank reserves and treasury issuance, it looked manageable. Well, Darrell has already alluded to the fact that there's by several orders of magnitude more treasuries out there than we had anticipated. Central bank reserves did not go on that steady path downward, which was expected in the aftermath of QE and the global financial crisis. Instead, those have ballooned as well. So I think even strong supporters of the leverage ratio as a backup tool for capital need to come to grips with this in the United States, and we just need to adjust the enhanced supplementary leverage ratio. Will it solve everything in the Treasury market? No. And Darrell has got this multi-pronged approach, which has always seemed to me persuasive. I honestly don't know how much the dealers would increase their intermediation, particularly in periods of stress. But it seems to me that, as Darrell has said, if you compensate for a reduction in the ESLR through, in my case, using a better stress test, then that really does seem to be, if not Pareto optimal, as close as we get to it in the messy world of regulation. There is a constraint on this which hasn't been widely recognized in the U.S. As of January 1st, the Basel rules have changed. And there's now a surcharge, they call it something different, but a leverage ratio surcharge on the global systemically important banks in the amount of 50% of their risk-weighted surcharge. So the U.S. cannot just eliminate that 2% and stay consistent with international standards, but we could just adopt the international standard so that J.P. Morgan's leverage ratio, ESLR requirement would be 4.25% rather than 5%. And Goldman Sachs's, I think, would be 3.75% rather than 5%. So it would create some space there. The second thing we could do is Darrell already mentioned this, so I don't need to go into detail, just be a lot more transparent about the circumstances under which the Fed will purchase treasuries. And if we do that, then we could use in a stress period the ability to, under Basel, to exempt central bank reserves from the denominator of the leverage ratio to provide some additional relief as well, most appropriately in those periods of stress. Having said those two things, and that, by the way, can be done now. You don't have to wait for a calm period. There's no reason not to make these changes. And I think, with the Fed's review of capital generally, this would be a very opportune time for them to make the coordinated change of tougher risk-weighted requirements and more room in the leverage ratio. Having said all that, the banking system, I think, looks pretty good 15 years after the global financial crisis. You can't say that for non-bank intermediation. Martin had a couple of slides making the point. To me, it has remained the major unfinished business of the post-global financial crisis reform, and it's only increased in importance through the regulatory arbitrage practiced by non-bank intermediaries as the prudential regulation of banks tightened, and again, as you would expect from me, I think appropriately. In the spring of 2020, the stress was most evident not in the banks, but in hedge funds, money market funds, mortgage REITs, short-term bond mutual funds. All of them experienced either runs, threats of runs, or funding squeezes, or some combination of those. Just to highlight a couple of intermediaries, hedge funds have been among the fastest growing forms of intermediaries in the last 20 years. They now hold about $10 trillion in assets, which is twice the amount held by broker-dealers and 40% of what's held by insured depository institutions. Yet, listen to this excerpt from the latest Fed Financial Stability Report. Comprehensive measures of hedge fund leverage remain somewhat above their historic averages. These measures, though, are only available with a considerable lag. More generally, leverage at many types of non-bank financial institutions can be difficult to measure or monitor in a timely way with available data. These gaps raise the risk that such firms are using leverage positions which could amplify shocks, especially if they're financed with short-term short-term funding. This is central bank speak for we really don't know what's going on. And that's sort of deeply troubling. The same report noted continual concerns with the vulnerability of money market funds, which had to be supported by the Fed in both 2008 and 2020, and with short-term bond funds. And then finally, another intermediary, which some years ago got a good bit of attention when the Financial Stability Oversight Council designated 3 big insurance companies as systemically important. Those have all been de-designated. And yet, what has happened with life insurers? Well, 15 years ago, big life insurers in the U.S., on their balance sheets, about 25% of their balance sheets were illiquid assets, things like commercial real estate, illiquid corporate debt, alternative investments. Today, it's pushing 50%. Short-term funding is also up, so this is not being principally financed with premiums. It's being financed in an alternative way. And the Fed has continuously identified the funding structures of these large life insurers as a potential risk. So that's the situation. It's somewhat better than in 2015, for example, but not nearly as much as it should be. What to do about it? Well, First off, there are some issues of legal authority. The SEC, even if it devoted an enormous amount of attention to hedge funds, it has very limited legal authority over them. Could the Fed and the SEC do something together about repo markets? Yes, they could, but not about hedge funds as institutions. Secondly, the SEC in particular has an enormous amount on its plate. Some of it is grabbed onto its plate, other things have been pushed onto its plate, but one way or another, it is not able to devote the kind of attention to what I would term prudential market regulation, that is making sure that markets are not only transparent, but that they're also operating in a way that's not creating risks for financial stability. And even and the Treasury Department, which has a secretary and an undersecretary who probably know more about financial stability than any other officials we could imagine. I mean, they've been focused on the Treasury market to some degree, but again, crypto has been pushed in front of them. Ukraine, sanctions, all these alternative these other issues, as a result of which non-bank financial intermediation, I think, is still a glaring area that hasn't been addressed. And to me, if we're going to do it, it's got to be done in a way that comes to grips with the different market models. You can't do it by simply saying, well, MetLife is systemically important, BlackRock is systemically important. You have to get to all money market funds. You have to get to the entire repo market. You have to get to the sources of funding, no matter what kinds of institutions are dealing with them. And that would take a kind of coordinated effort, probably coordinated through the FSOC, that, again, at least to date, there just hasn't been the opportunity for. I should end probably, Cornelia, by saying that Andrew Metrick and I have a paper that we call Congruent Financial Regulation that came out a couple of years ago that develops this in a little bit more detail using the Treasury market as an example. So I'll stop there. Thank you.
Thanks very much, Dan, for giving the U.S. Regulatory perspective. Yeah, very, very interesting comments. I mean, I can much relate to your concerns about the stress testing single scenario. I'm just engaged in that. So just to say that the last EBA-wide stress test that was done in the euro area assumed a lower for longer interest rate scenario. And we are, of course, very far away from that at this stage. So thanks very much. But now let me turn the floor to Peter. So Peter, now, this environment, as we just heard, poses lots of challenges for central banks. So when deciding on the pace and modalities of monetary policy normalization, how and to what extent should financial stability considerations be taken into account? And how would you see the balance between interest rate adjustments and balance sheet reduction, so the QT? Please.
Thank you. It's very interesting comments I heard so far. So thank you very much for the invitation. My first point, circling back, to Martin's presentation, we have to make this distinction between extreme events and sort of correction of bubbles. Extreme events like COVID are quite different from the dot-com or the October, what preceded October 87, or what preceded the global financial crisis. So I put usually two categories where central banks intervene decisively and very quickly without hesitation when you have extreme events, accidents, earthquakes events, COVID events, Y2K and September 11. These are one categories of events. And so, Darrell, I thought what happened in the Treasury market reveals a lot of weaknesses, but it's also a very extreme event we had at that time. So we have to be a little bit careful because it's not so difficult to discriminate, by saying no, intervene massively. And in other cases, it's more complicated. So that's my first observation. I went into many correction of bubbles in my life. October 87, so that led to the Greenspan put, this moral hazard issue, which is still, quoted by many people in the markets. At some point, central banks are going to intervene, and to what extent is there financial dominance in monetary policy making, Cornelia? So that's one sort of consideration that we have to keep in mind. The dot-com correction. You remember also that the Federal Reserve, I was, around the table in the G10, when Greenspan announced, why they lowered, suddenly the rates, after the dot-com correction. And many of us were amazed of that. They were surprised of that. Basically, I think, probably there was a policy mistake in the US, because basically the idea was that the dot-com would create a huge wealth effect and that would slow the economy very much. And we didn't see much impact on the economy of the dot-com. And I think monetary policy after the dot-com correction was too loose. So one has also in the distinction between the corrections of the exuberance, one has to really look, and it's difficult, I really admit, I think the comments, also from Dan were very good, actually. It's very difficult to know exactly when a bubble corrects, what is the leverage and liquidity risk which is in the market, because what matters in the corrections of bubbles is the spillover issues, the amplification effects. And in the dot-com correction, huge bond market and equity market corrections, but there was not much leverage. Many people lost money. So one consideration is to look at this. And the other one, of course, is consumer protection, which is beyond, discussion today. But these are the two things. So the crypto, Martin, to come to the crypto, I really don't care. I like the market to test new things. I'm very worried about, consumer protection. Of course, there are many issues there, young people putting money, but the leverage and the spillover of the crypto so far seem to be limited. But I think that's one has to look, because you always have to be careful not to repress financial innovation. So it's a very tricky issue, I fully admit. But I think in general, when you look at the dot-com, I still see a lot of benefits coming from the exuberance at that time. If all people, put a little money, in exuberance, in technological ventures and all that, and if they get it wrong, it's not necessarily a bad thing for society. So one has to be very careful when we talk about regulation or interventions in markets, also not to intervene too quickly, of course, when there is a correction, that's a moral hazard. But one has to be careful not to repress innovation. I'm talking about real innovations, like including maybe the DLT, and what is with fintech related. So I think the balance is very difficult to see. So we always have to look at leverage and liquidity risk in the systems and our infrastructures. Darrell, I think you do fantastic work there since years. We have to look at, the plumbing and to see, can our institutions absorb, when people take ventures, in some direction, and they get it wrong, of course, and then there is a correction. Can markets absorb, in a smooth way these adjustments? And that's not always the case, as we know. Now, when I look at very quickly, Martin, I make now a summary of what you said. We had a substantial tightening of monetary policy, big corrections in asset prices, but so far no severe systemic stress. There have been limited stress, as you mentioned before, but at the systemic level, we haven't seen much so far. Then also you mentioned the banks so far. And so we have to understand why is that? Because when you look at the literature on monetary policy, you see that low rates for too long increase financial stability, risk very much. And so far we haven't seen much, realized, financial stability risk realized. We have some episodes which have been mentioned, but it's not really systemic what we have seen so far. GameStop that you mentioned, or the crypto, and even I would say the LDI related UK stress. It's so far has been relatively specific to the UK. When I looked at reports from the Netherlands where they have huge pension funds, I don't see the same degree of leverage that you had in the Dutch pension funds than what you have seen in the UK. So I see the UK a combination of fiscal exuberance indeed, and probably excessive leverage and liquidity risk in one part of the pension, part of the pension system in the UK. So why so little impact so far? First, it's too early to tell. That's an old thing. So it may come. Markets may underestimate the future path of rate increases. So they may be too benign. You could say that there is a sort of Goldilocks view of the disinflation process. Markets say it's going to be a soft landing. There's a lot of inflation related to energy and food prices, disruptions related to COVID, and this is going to settle. So they take a sort of Goldilocks view about the disinflationary process. If they get it wrong, there may be, of course, a severe correction in asset price from what we have seen today, because there have been already severe corrections, but so far without a lot of spillover. The other point, and I think that's more interesting, is to say that this time is different. Market participants have learned. I think this is very important, Martin and Cornelia. Is that really the case? I read a lot about the debt fundamentals, balance sheets, are stronger, not only on banks, as Dan was saying, but also the balance sheets of households. I'm talking about US households, about NFCs. And even when I discuss with some real estate, asset managers, they're much less leveraged, they say, than they used to be, because they learned from the global financial crisis. Now, as Dan was just saying, there is a very important thing. There is a shadow part of the market which really developed, the private market, which developed very much in the last few years, and that we haven't seen the price adjustment that we have seen in the other sectors. So there may be hidden risks there in the private part of the market. And that's something I hear in the real estate, the commercial real estate market, for example, today, that when you look at the return about what is quoted, listed, and what is not listed, where the information comes with delay, it's not very good information, there is huge difference of return on equity between the two categories. One is, of course, delayed, but we don't know very much. Bank regulation, the third argument, bank regulation has succeeded a little bit, to a large extent, by basically not only, but shifting risk to the non-bank financial institutions. But maybe they're more able to carry the risk, some of them. If you shift risk maybe to wealth managers, if they manage wealth correctly, I think it's much better to have disintermediation of finance to non-banks than to keep many of the intermediation within banks. Now, we know a number of the problems there in the non-banking financial institution. Then you mentioned them. I fully agree with what you said. It's still a big unknown. But we also have to think about, maybe to a large extent, the big risk shift from banks to non-banks is a good thing. But then comes a question, of course, and that's for my last part, is the question about, of course, the regulation of the non-banks. And I think that's the key weakness, as has been mentioned. And there are two other points why, this resiliency is that the tightening, that's a very important point. The tightening strategy of central banks has basically, the accent has been put on interest rates and not on the balance sheet. And probably the central banks say we want to have an orderly process, etc., etc. But do we know today if the mix between rate increases, a bit more aggressive, and sort of a very prudent balance sheet adjustment of the central banks, is that the right mix? I don't know. I probably would say yes. I would probably defend that. But we should also explore the other possibility, is that by keeping this huge portfolio of banks and saying, I'm going to do that, keep it for a very long period of time, I'm going to be very careful, maybe what you have is an impact on the yield curve, on the term premium, which remains relatively depressed. If you have, as Martin was saying, 40%, of the public debt on your balance sheet, and you don't want to normalize that, it is clear you increase the short end of the curve, and the long end, remains to some extent, compressed. This is a preoccupation which I heard, from several central bankers in the euro area, and we don't know exactly what's the right balance between the two. You could imagine, for example, that QT is more aggressive than what it has been, announced, especially in Europe, but it should be complemented by what has been said before, stability, QE. I mean, market interventions, if the process becomes disorderly. But as Darrell was saying, very wisely, is that you have to communicate in a transparent way, to avoid the confusion between what is QE and what is stability, interventions that you do, and what are the conditions under which you are entering. I fully agree with that point. And I think probably the central banks are going to work, for this. Also because The day you have to reinitiate QE, who knows in the future, you will have to have a better framework, explaining what you do, what are the objectives, and also what are the exits. And the final last point is the role of the state as a backstop in general. It could be today that because of the interventions we had also with the global financial crisis, with the COVID, the Russian invasion, all these shocks that we have recently, that there is a sort of moral hazard in the system where market participants, say, for example, in the present environment, the geopolitical environment, we cannot afford a financial crisis. And so markets, take a sort of benign view because they say the tails, will be taken over by central bankers or by the state, in general, as they have done with the COVID and the Russia, at the peak of the Russia stress, they've also intervened, and they take probably a benign view. The conclusion of all this is, yes, it might be, but we have to work on some of the things which have been said before with Darrell, and then we have to work actively. As Dan was saying, it's not in crisis that you can change the regulation, except for what you have mentioned. There are some exceptions, but we have to urgently finalize this work, and especially on non-bank financial institutions. And I stop with this, because there is also a sort of, I lift that, and then you lift that also, in the FSB, maybe in the Basel Committee, is that at some points, governments like central banks, because they say regulation is a complicated thing. You have to deal with lobbies also and a lot of political problems. So you say, let the central bank fix the problem when it comes, and not rush into regulation. So there is probably also a sort of moral hazard, a relation between the state, governments and the central bank. So central banks should, and that supports again the points of Darrell. That supports the point that central banks should clarify what they will do, in what circumstances, but not a blanco check, And so, thank you.
Thanks very much, Peter. And when now opening the floor for further interaction, this moral hazard argument was also on the top of my mind. I mean, I very much agree with what all of you said, that the central banks, of course, do have a role to play to stabilize markets. And I thought the Bank of England intervention after the gilt episode was really exemplary. So I think they really managed to distinguish between the monetary policy objective and the financial stability one, and they made a very targeted and timely, constrained intervention. So I think that worked well. But I always feel that central banks have become really massive intermediaries in financial markets. And personally, I was happy to see that maybe this would now be going down slowly over time. But when I hear you, so Darrell, you mentioned this transparent purchase program, and where I wonder what would be thresholds for central banks to intervene and when not, and whether should we really be so transparent, or shouldn't we keep some constructive ambiguity as to when central banks would come in, because indeed the moral hazard problem, I think, is one. And Darrell and Dan, I think you both mentioned non-banks and their access to central bank balance sheets, and I would see a little bit the same issue there. And shouldn't they be first regulated before we give them access? So with that, I'd like to open the floor, but please also come in and comment on each other's interventions. I don't know, Darrell, you want to have a start?
I'd like to go back to moral hazard because I think it's absolutely central. In the end, when the crisis hits, the central bank is going to need to move, and there's no amount of avoidance of moral hazard that's going to cure the problem at that point. So coupled with these emergency intervention programs, like the one I mentioned today, to purchase treasury or government securities, it's imperative that the official sector makes the market more resilient so that the moral hazard is reduced. If you simply say we're going to be there to rescue the market, then the commitment to improve market structure, the commitment of intermediaries to set aside capital so that they can take advantage of market volatility when it comes, all of these kinds of benefits coming from the private sector and from anticipatory regulation, they drop away because everyone just waits for the central bank to rescue. So it's kind of a, as Andrew Hauser at the Bank of England says, it's a grand bargain. You you hold out these emergency purchase programs and you require improvements in market structure. I will say that the moral hazard is really more, as I've spoken, on preparation of the market structure than on hedge funds or others taking advantage of the put. Because if it's well understood that the central bank is going to provide liquidity under stress, then that's going to get priced into the Treasury securities when they're issued, and people will have to pay for that put. The moral hazard is more on malaise regarding improvements in regulation and market structure.
Thank you. Dan, do you want to take over?
On the moral hazard point, Cornelia, I would just endorse what you said, that, and Darrell has reiterated it. So right now, there is a widespread expectation confirmed by 2 crises in the last 15 years that if there's a lot of financial instability, the Fed will step in, as will the ECB and the Bank of England, the Swiss National Bank, and the Bank of Japan. And no matter what they say they're doing, they're going to be providing liquidity to a bunch of intermediaries who have not been constrained ex ante by any regulatory structure. And I think the problem has been that people have talked in terms of, is this institution systemically important, and thus, even though it's not a bank, it needs to be regulated. And I just want to reiterate, and Darrell, the subtext of Darrell's comments, I think, also underscored this point. It's the activities in which intermediaries are engaging. We need to cover small money market funds, not just Fidelity and Vanguard. We need to cover all actors who have a business model that relies upon short-term funding in which, haircuts that are too small or exposure that's too large can either originate or amplify stress once it occurs. And that, to me, thinking as a law professor rather than as a central banker, the institutional challenges of getting a regulatory system that do that are pretty significant, because authority is dispersed over a bunch of different agencies, and there's a need for coordination, which I'm here to tell you, having spent 8 years in interagency meetings trying to agree on regulations, it's not easy to achieve, which is why I come to a very sort of non-quantitative, non-economic point that I think it's going to take, in the US at least, leadership from Treasury to really be able to do this. And I would suspect in the EU, it's got to be the ECB, although, you folks would be much better positioned than I. But I say that only because it seems to be the only institution that really has the heft to function and to pull things together within the Eurozone.
Cornelia, if I may, the problem is that the central bank, and that's a very big challenge today, is to assess, the lags in the transmission of, the monetary tightening. And the lags are long and variable, as we know, but they can be very short. And when you have financial instability, usually it has an impact on the economy, and this later on inflation. And so the central bank are a little bit, they intervene not only because, sort of vague, financial stability consideration, but also for monetary policy consideration to ensure, a proper transmission or smooth transition of monetary policy. We know that in banking, of course, and that's why they intervene. But you have a little bit the same in the market, and it has to do with the very big complexity in assessing, how long does it take, to influence markets. And you have two extremes, one is that the markets, take a too benign view about your monetary policy. So the lags, are so long, that your tightening has no impact. But this is a little bit, a situation we faced recently. The last 2 days it changed, because bad inflation figures in the US, but relatively. But the other one is that it can go the other way, that the lag can be very short. The transmission via capital markets can be very short if there is instability. And so the central banks, a little bit, it's not only the question about financial stability per se, but it's a transmission for inflation reasons. But we have the two extremes, as I say.
Thanks, Peter. We have a couple of questions in the chat that maybe you could address. So to Darrell, there was the idea that maybe, so if it's not the central bank, no, who does the emergency purchases, might it be public debt management agencies that could be the right institutions for the market making of treasury markets? And don't some of them do that anyway? And then maybe to also, against what would they buy government bonds? Would they provide liquid funds to banks, and they can and should not create central bank money? That would be, of course, one consideration. And then a question to Dan on stress testing and non-banks. So shouldn't we think about extending stress testing beyond banks and also consider non-bank financial intermediaries to better capture other areas of fragility? And what could be the consequences for regulation and supervision? Very good questions.
Let me address the first one. Fiscal authorities typically do what are called buybacks, which they're done to manage individual securities that are illiquid and try to improve the liquidity of the average security by buying back the illiquid ones and issuing more of the liquid on-the-run securities. Frank Keen and I were working on this proposal, did a comprehensive survey of what fiscal authorities are doing with these buybacks, and they're not using these to mitigate general market dysfunction or financial instability. And we're mooting the idea that they might consider doing that because it would relieve concerns about central bank monetary policy and also central bank independence, because who's to say that when a sovereign debt market gets into difficulty, that the central bank is simply improving market functioning on the one hand, or it's bailing out the sovereign on the other. One can wave the market function flag and put the central bank in a bad position at times, depending on the jurisdiction and the time. And the fiscal authority really takes primary responsibility for the quality of its own securities and for the quality of its own market. The central bank is there, yes, to provide market stability as well and to provide monetary policy. So relieving some of that tension, not to say that in every instance the fiscal authority should take charge, but relieving the central bank of some of that responsibility in a coordinated fashion perhaps could be at least worth analyzing.
On the stress testing for the economy point, so say a few things about that. I agree with the proposition that as a diagnostic tool, it could be very useful. But I think it's got to be a different kind of stress test from the one that we and a number of other jurisdictions use right now for setting bank capital requirements, for a couple of reasons. One, it is used to set capital requirements, and unless you're moving into a world in which every former financial intermediary has a capital requirement, then it's not going to be quite as well suited to what you're trying to achieve. So that's number one. Number two, at present at least, the Fed would have to do a lot of guessing about what the balance sheets of these non-bank intermediaries look like. And you know, I would not think that the kind of stress test that they could come up. Well, I should say that I don't think it's been enough years now. In my last couple of years at the Fed, I was asking our staff about this because the Bank of England was getting kind of enthusiastic about system-wide stress testing. And folks basically said, yeah, we could do it, but gee, would there be a lot of estimates? And in particular, we wouldn't be comfortable releasing it publicly because we wouldn't have a lot of confidence in the inputs, which of course mean you don't have a lot of confidence in the outputs as well. So the same issue that I mentioned and echoed in the Fed's financial stability report of having access to the kind of granular information you need to do a sensible, useful stress test, I think continues to be an issue. And just, Cornelia, if I could add just one little point, this is the notion of stress testing in the abstract, I think sometimes confuses, not the people in this panel, but I think it confuses people sometimes. And we've seen this with climate change. When people talk about climate change stress testing, they don't necessarily mean the kind of stress tests that are done now to set capital requirements for banks given the next 8 quarters or 9 quarters. They're sometimes referring to something quite different. That's what the Bank of England meant. I think that's what the Fed's initial thinking is about. And I'd say the same thing about a system-wide stress test. You're maybe looking for something closer to what the IMF does in its financial stability assessment program of trying to look at the economy at a fairly high level and see what you can learn by doing it.
Thanks, Dan. A very good point. I was struck by your point that there's not enough information on non-banks. No, I mean, isn't that quite surprising after all this time? I mean, if I think back, the LTCM crisis was 25 years ago, 1998, if I recall correctly. So I don't think we have made a lot of progress here in this regard. But I could imagine that with the recent events, starting with March 2020, the failure of Archegos and the gilt crisis and so on. So maybe that gives a push to the regulatory agenda also on the international level. So I would certainly hope so. I would have one question to Peter. So you elaborated a bit on the pace of QT, no? How difficult it is, and can you elaborate a bit how to determine the pace? I mean, you said that probably what is being done now, this very careful approach is fine, but could one go a bit further, a bit quicker, or would you see that very quickly some dangers? And would you see a role for macroprudential policy? I mean, you could think that you have a tighter macroprudential regime to ensure, better resilience of banks, in particular at this point in time, no?
No, these are very difficult questions because I don't have all the information. I like, and I think, that's the point of Darrell actually. There is a lot of writing, from market analysts about, the portfolio of the central bank. And they make simulation about the aging of the portfolio. They make simulation about, the other side, the demand for reserves and the supply of reserves. And then you see at one point, when do you reach, a point of tension? So that's one of when people make projections, for the next 2 years, I would say, they look a little bit about that. At some point, the reimbursement of the TLTRO, the funding for lending, plus probably the increased demand for reserves that you have, is going to create a tension much faster, I think, that what usually the consensus is. And we see that also in the US, I think. And the worst thing, of course, would be to accelerate too much, QT, and then to have to reverse more fundamentally, not only intervening, because there is a spike in the market, but just because you got it wrong, on the tension between supply and demand of central bank reserves at some point. And it's a very complex discussion. So as I said, Cornelia, I would probably support the point that you have to do it in a prudent, orderly way. But on the other hand, I would like to hear the devil's advocate, and how can you, if you accelerate it and you make your simulation, and what would be the impact on the market? I know it's very difficult to do, but I think it's absolutely necessary. And I'm quite worried about this. Cornelia, that a number of governors, not only 1 or 2, but more than that, expressed their concern about the fact that, you continue to reinvest, broadly, a lot, basically you keep your portfolio, you let it aging, but you keep it. And the impact on the term premium, of course. And the fact that in the US, in Europe, we have an inverted, yield curve, the 2 years and the 10 years. I mean, it's incredible. And it's not consistent, with the market's view about the future. There are a lot of inconsistencies in that sort of price. So the conclusion many people now start to make is that, there is a fundamental distortion where the short end goes up very rapidly, but the long earn, is held by, QT policy, you know, very careful QT. I think the UK tried to go faster. I think I see it in a way as a success story, as you said, Cornelia. But you cannot just go faster for QT without, I go back to Darrell, without looking at all the implications and your readiness, you know, to intervene suddenly in the markets if you get it wrong. But getting it wrong when there is a specific event is okay, like the UK. Getting wrong because the whole policy of exit, you know, is wrong. You go too fast and you misunderstood, you know, the tension between supply and demand for reserves. That's more serious, of course, if you make that sort of mistake. There is one point, a different point, Cornelia, with Darrell and the public debt managers, you know, offices, you know, the public debt managers. A lot of these DMOs are discussing with the primary dealers to give incentives, Darrell. I don't know if you could maybe, if we have a minute to say something, because DMOs are very worried about, you know, market conditions, the liquidity conditions, possibly of QT, and that the rates, you know, may increase much more than what people think today. So the difficulties, you know, with primary dealers is not only a question of balance sheet, it is, of course, a question of balance sheet, but you think that incentives, because they're discussing a lot of incentives now, would make a difference? Probably not, I think. At the margin, maybe, but not. It's a very important question now.
Please, Darrell, you want to come in?
Just yes or no? Yes or
Yeah,
no.
no, I think the incentives are crucial, and the debt managers are discussing market conditions with the large dealers. In some jurisdictions, most of the purchases by central banks are bilaterally negotiated with dealers rather than by reverse auctions, and in, that's a tricky situation when you're involved in operations that are restoring market liquidity with the same individual firms that that rely on you for information. That's tricky, sensitive information. I would generally suggest doing reverse auctions rather than bilateral negotiations. And also, there's been increasing discussion of not relying as heavily on a small number of dealers, but rather providing direct access to primary market issuances and possibly also purchases to a wider set of market participants. That also mitigates some of these balance sheet concerns that dealers face if you can operate directly through large investors and not necessarily with designated primary dealers.
Very interesting. Thank you. Thank you.
We are nearing the end of the time that is allocated to this panel, so maybe we can close off with one final question that I would ask you with expecting a short answer. So, I mean, in view of this challenging environment where we are in right now, if you had to choose one, where would you see the largest risk for financial stability at this current juncture? If you just name one, and then with that answer, maybe we can close off. It will help me in doing my job in monitoring financial risks.
Fiscal policy. I'm very worried about fiscal policy.
Fiscal policy. Yeah. Thank you.
Geopolitics are scary.
Yeah, but that's part.
Geopolitics, sorry, and thinking about like trade tensions, or do you think about energy prices, or where would you see it?
Well, there are so many dangerous corners of the world right now, but certainly military conflict. There's not just the war in Ukraine to worry about. And then there are, countries can go off in a fit of pique and change trade market conditions in a way, or foreign exchange market conditions in a way that can suddenly upset markets. So those things concern me. There's also an increasing polarity in financial markets now, where certain players, certain actors are withdrawing from global financial market infrastructure, like payment systems, developing their alternatives. The world is getting much more influenced by geopolitics than it was 10 years ago. And I'm not sure these can manifest instantly into a financial crisis, but they certainly raise financial stability or financial efficiency considerations.
Thanks very much. Dan, you have the final word.
Yeah, I mean, Darrell, I knew what my answer was going to be until Darrell spoke. Because I think Darrell, I'm sort of with Darrell in the sense that I think it's the greatest risk right now is probably an exogenous shock of some sort, a shock genuinely exogenous to the economic system. And he made the case for the fact that it's not just kind of fantasy that something like that could happen. If you stay inside the financial system, though, or inside the economy and the financial system, I'm still, and this may be more of a U.S.-centric concern, I'm still concerned about the areas, the non-bank financial intermediaries where we just don't know enough about the combination of leverage and short-term funding. And I hope I'm wrong about that, but if I were back at the Fed, that's where I'd be having the guys in the financial stability division spending a lot of their time right now.
Thanks very much. We will take this home, these views. So thank you very much for a very interesting panel. Thanks, Darrell, Peter, Dan. So yeah, I would hand back to Ernest. I don't know, do you want to have some closing remarks?
Thank you very much. This concludes our SUERF Baffi Bocconi high-level policy panel on navigating monetary tightening through fragile markets. Thanks again to Cornelia and to our brilliant speakers. Really, I think this was a very rich exchange and very stimulating. I wish you a nice evening. I hope to see you all soon at a forthcoming SUERF event. Thank again Martin Scheicher for initiating this and orchestrating this so well. Bye-bye and take care.
Bye.
Bye.
Thank you.
Thank you. Have a nice
Bye-bye.
day. Martin, Ernest, thank you so much. Cornelia, thank you.
Thank you.